Good afternoon, everyone. My name is Art Alvarez with MortgageWorks. Welcome to this week's Mortgage Minute on this solemn 80th anniversary of the D-Day Normandy invasion. So please keep all of our servicemen and women in your thoughts. It was certainly a very critical day in the history of the world and our country 80 years ago today. And by the way, I might look like I have a little extra tan going on. Not quite the case. As I think we mentioned last week, we just moved our office. We had to move because our building got sold. And in this office where we're at, we don't have very good lighting. So I'll be sure to make some improvements on that next week. So I look not quite as tanned, as I'll call it, as I do today. So as you know, with this program, the first thing I want to do is give you a mortgage rate update. So let's jump right into that. And I've got good news for you. We've had some good improvement in mortgage rates here in the last week or so. Here's our rate grid that's on our website. And what you can see now is that we're back to sort of the mid sixes on the conforming loans. And nice to see that both FHA and VA loans are now back under 6 at about 5 7/8. So that's really good news. And there's a variety of reasons for this, which I'm going to touch on. Jeff's going to pull up the chart of the 10-year Treasury bond yield, showing the improvement over the last 5 days, going back to last Friday. And that's the kind of slope we like to see. You can see last week we were, nearly 4.6%. Now we're down under 4.3. So that's a nice improvement. So generally speaking, mortgage rates are about plus or minus 0.3% better than they were a week ago. And that improvement seems to be holding as we finish up this week. So what is going on here? Why did we see this improvement? Well, it goes back to last Friday. Last Friday was the release of the PCE, also known as the Personal Consumption Expenditures Index. Remember, that is the Fed's favorite inflation gauge. And that number did not go up, so it wasn't considered hot, as they call it. And in fact, the core PCE, which excludes food and energy, saw the smallest increase this year for April. And then the other thing that helped with our bond yields, and I've mentioned this before, the labor markets are very important in terms of the financial markets and bond yields in particular. And this week, the JOLT report, remember that's job openings, labor turnover, came out at a 3-year low. 8.1 million job openings. That's down from 8.4 million the previous month. So that was a real good shot in the arm in terms of improving bond yields, because that's reflective of the fact that maybe companies, corporations, employers are not hiring as many people, which may be a sign of some softening. The ADP employment number, ADP said 152,000 new jobs were added versus 175,000 forecast. I'm not a big fan of ADP. It can tend to be a little bit more inaccurate and kind of have some wide swings in their number. So I don't put too much credence into their number, but yet it did help the market. And then, of course, today we had initial claims for unemployment. That was actually up a little bit, 229,000. That's a 4-week high, although overall it wasn't considered indicative of the labor market softening very much. The more important news today was the European Central Bank, Europe's version of our Federal Reserve. The European Central Bank did cut their rate 0.25% today. That's the first cut, in fact, since 2019. So they did what was expected. That also has helped us with our 10-year bond yield and kept it at a steady right around 4.3. So then we'll see what happens tomorrow. Tomorrow is the U.S. employment report. The forecast is for 190,000 new jobs versus 175,000 was the April number. And then the unemployment rate is forecast to be no change and stay at 3.9. If either one of these numbers turn out to be soft, in other words, if we have less than 190,000 new jobs, maybe a lot less, and or if the unemployment rate ticks up, hits that 4% threshold or higher, I think that will be a stronger signal that the labor market is starting to soften. And then that should help us not only maintain our current level for the 10-year bond yield, but maybe see some more improvement. So with that, I want to go ahead and go into our next subject, which in this case, what I'm going to do is talk about an article that I saw recently. This was on Yahoo Finance, and it was an article about Grant Cardone's prophecy rings true. You can see the headline there: U.S. mortgage drop bolsters warning on short-term rentals. And I thought, what is that all about? Now, of course, you may know Grant Cardone. He's pretty popular. He's almost a celebrity, but he's a real estate investor. I've seen different numbers that his net worth is a 600 million to a billion. I've seen him referred to as a billionaire. A lot of his focus is on the real estate market and real estate investment. So here's a kind of a summary of what the article is. I want to go over this for a couple of reasons. One is it's got some pretty good data, but number two, there's some quotes about Grant and what he thinks that the current market is signaling that I was kind of scratching my head about. So let's get into it. First of all, the article points out that U.S. home buyers took out 40% fewer mortgages in 2023 compared to 2022. Well, that's a duh moment, right? And I can attest to it. Yeah, the mortgage business certainly is a lot softer than it was even in 2022, and certainly much softer than it was during the pandemic. But what was weird is a 40% fewer mortgages in 23 supports Grant Cardone's advice to avoid short-term rentals. I was having trouble connecting the dots on that. I'm not quite sure I understand why you would draw that conclusion just because mortgage volume is down so significantly. And then, of course, it goes into his advice that he emphasizes real estate as a long-term investment, not a get-rich-quick scheme, as if purchasing a property to use as a short-term rental is somehow a get-rich-quick scheme. I can't connect that dot either. I mean, it doesn't make a lot of logical sense to me. What it does point out with respect to second homes in particular is mortgages for second homes fell by 65% from the peak in 2021, while primary home mortgages dropped by only 20% year over year in 2023 and 35% from 2021. Now, the article points out some reasons for that. One, of course, being that second homes are more expensive and non-essential. In fact, that's what I would call essentially a discretionary purchase. Second homes tend to be purchased by folks who are, pretty well off income-wise, because that means they're going to be carrying the expense of more than one home. And second homes generally, at least historically in the mortgage business, have always been considered, vacation homes. In other words, second homes most of the time are purchased as a vacation home to be used by the property owner during the year for vacations, obviously, and they're usually located in resort areas, which of course tend to have higher property values. And so, of course, with rates up, home prices up, it would make some sense that maybe there's less activity, and we are seeing that less activity with second home purchases for those reasons. The other reason for the drop, the article pointed out, was increased federal loan fees in 2022. Well, what that means, and you may remember this, we covered this quite some time ago. A couple of years ago, 2022, the federal mortgage agencies, Fannie Mae, Freddie Mac, significantly changed how second mortgages on second homes are priced. It used to be way back when that a second home, if you got a loan for a second home, that the interest rate you would get would be essentially the same as for a primary residence. There was very little to no difference in the rate between a primary or second home. There'd be a little bit of a difference in terms of minimum down payment requirements, but otherwise the rates were essentially comparable. That changed in 2022, and it changed significantly. Second homes now, mortgages on second homes, are essentially priced like rental properties. So now the rate on a second home is basically the same as if you're buying a home to rent it out full time as a real estate rental investment. That, I would say, is probably the single biggest reason that second home purchase activity has diminished from what it used to be before those increases in the loan level price adjustments, remember that term, on these second homes, which is now causing those rates to be the same as a rental property. And of course, it also talked about how the rental market for second homes has softened. Now, in addition to that, there's a couple of other things, these expert insights. High prices and rates have reduced demand for vacation homes. Well, of course, cash buyers do show some interest That's particularly true, by the way, in my market here in the Palm Springs area, Coachella Valley. It's amazing how many transactions out here continue to be cash transactions, which, of course, as a mortgage originator, I'm not thrilled to see that, but it is what it is. And so, yeah, I would say that to the extent there's still some firmness in second home purchase activity, it's probably has a lot to do with cash buyers versus those who are, as they say, mortgage dependent. And a lot of those buyers are still waiting for rates to improve. The other reason attributed to the softening of second home purchases is more employees are returning to the office, reducing time for vacation homes. What that means, of course, back in the pandemic, second homes were being purchased at a very high rate, and in part because most people were working from home. And if you're able to afford a second home in addition to your primary home, that gave you that flexibility to occupy either one of those homes at different times and still be able to perform your job. Well, there's less of that going on. And so that's been attributed to as a reason why second home purchases have softened up quite a bit. And then lastly, vacation home demand remains low in 2024 with mortgage rate locks for second home mortgages near an 8-year low. What I find a little bit odd about Cardone's comments about warning about short-term rentals and suggesting that this mortgage volume drop is an indication that second home purchases are not a wise investment. I'm going to kind of push back on that. There's really a couple of reasons why. If you have the income sufficient to carry an additional home in addition to your primary home, a second home can be actually a very rational thing to do if, number one, you'd like to have a property in a resort area that you would like to use from time to time for vacation. Obviously, that makes a lot of sense. What's changed about the second home landscape is, in the old days, a second home, at least in the mortgage industry, was considered a home that was available for the owner's year-round use. That's why we call it a vacation home. Typically in a resort area, it would not be subject to rental pools and so forth. What happened in that second home arena is, and I think it really kind of took off during the pandemic, people started to realize that as an owner of a second home, when they were not using it, they were in their primary home, it was sitting there essentially vacant, then they had an aha moment and realized, why not take that second home when I'm not using it in that resort area and rent it out? That way I'm generating additional income, additional cash flow to help support the cost of that second home. And, with the advent of platforms like VRBO and Airbnb, again, I think the market just rationally realized that second home could be used in a different way. You could generate income for it when you were not using it. I mean, again, that's a very rational economic thing to do. But at the same time, that kind of created a shoot yourself in the foot scenario. Why? Because the agency, the federal mortgage agencies, figured out that was happening, and it was happening at a very high level. And so in that case, what the agencies, I think, realized is that these second homes were not really just available for the owner's year-round use and not subject to rental pools, but in fact, many of them were being placed on Airbnb or being placed on VRBO. Again, generating good income, nothing wrong with that. That frankly helps that homeowner maintain that investment. And I would therefore disagree with Grant Cardone that this is really just another version of a long-term real estate investment that can really pay off and very well if you're in a good market that has still good, strong short-term rental activity. So again, with our current rules for qualifying buyers, if you're able to qualify for that mortgage for a second home, you should, I think, still look at that as a very sound, reasonable investment. It's not a get-rich-quick scheme. It's not something to avoid. It's a rational thing to do. And of course, if you're thinking about a second home, keep us in mind. We price those very well. I just priced one out yesterday, and we can certainly help you with that. So I think second homes, it depends on the market. Here in our market, Palm Springs, Coachella Valley, short-term rental activity is still pretty good. And so it can be a very, very good, sound investment. and something you should consider. If that's something you think you can afford, we can certainly help you achieve that goal. So that's what I have to say about Mr. Cardone and his thoughts on the real estate business. Of course, I'm not a bazillionaire like he is, but nonetheless, I think his take on that was a little bit strange. Now, one thing I've read about him recently too is he's saying, hey, it's getting too difficult to buy a home anymore. But then what does he go on to say? Buy a rental property. In fact, I read an article where he specifically said something we talked about many weeks ago. Remember the houses without spouses? He actually suggested, don't buy a single family home, buy a real estate investment property, like 2 to 4 units, live in one of them, rent out the rest. And he suggested that's the way you should invest in real estate. Well, guess what? We already talked about that. And in that case, I agree with him. He's right. And that's something we can also help you with. So with that, I want to go into now another article that I saw here recently that I really kind of chuckled at. And you may have heard about it. It's the nation's largest wholesale lender. They're called United Wholesale Mortgage, or UWM. Well, they recently announced a big new campaign. They've come up with a new program that involves 100% financing, essentially. And what caught my attention was this headline from this writer from CNN. You can see it there. A shady financial tool from the housing bubble era is making a comeback. And I thought, really? Let's look into this. So the article starts off with the introduction of the program. United Wholesale has introduced a zero-down mortgage program, allowing first-time home buyers to secure a home with no initial down payment. And by the way, I'll show you a little bit later, you don't actually have to be a first-time home buyer. There is an option to take advantage of this program without being a first-time home buyer. But as I read through the article, it had it was sort of dripping with sarcasm, a lot of snarky comments. So I wanted to show you a few of them here. It described the zero-down mortgage as a shady financial tool and sarcastically says, what could possibly go wrong? And then I really like this one. It likened the $15,000 repayment to a sword of Damocles stabbing you in the back. And then it warns that the situation could repeat past mistakes from the subprime crisis. That last bullet, past mistakes from the subprime crisis, and what she's referring to is back in the early 2000s and before the great crash of 2008. The situation now is entirely different from that subprime era, and I'll again get into that in a little more detail in a minute. But let's get into the program details about how this zero down payment program from UWM actually works. Well, the first thing to know, and it's very simple actually, the buyer will be able to, or the borrower will be able to get a loan of 3% of the home value, up to a maximum dollar amount of $15,000. And this would be combined with a first mortgage that they would apply for at 97% of the purchase price of the home. So of course, you take a 97% mortgage, and you're going to get this second mortgage essentially at 3% of the home value. Add those two together, that's where you get to the 100%. Now, this $15,000 does have to be repaid, but not until you either sell the home, you refinance the home, or maybe you just pay it off because you won the lottery, or when you've just finished out all the payments. Let's say you actually made all 360 payments, that junior lien will still be sitting there, and you'd have to pay it off when you pay off the loan in full. Now, the article goes into the risks that she wanted to highlight. It says if the housing market declines, buyers could owe more than the home's value, leading to financial distress similar to the 2008 crisis. I'm going to say yes and no. Part of the reason for that is the way mortgages are underwritten today is entirely different than it was back then. The other thing about the risks highlighted is, unexpected financial emergencies or home repairs could make it difficult for the homeowner after they get this financing package to save up the money to pay off that $15,000 junior lien. By the way, we also sometimes call it a silent second. Yeah, that may be true, but in reality, unless the market really does collapse and values fall, it's more likely that $15,000 junior lien is going to be paid off, not from having to save up the money to do that yourself, but because your home has gone up in value, you sell it in later years, or it's gone up in value and you're still going to keep it, but you want to refinance, then that's more likely how it's going to be paid off. And then the really kind of almost laughable comparison was comparing this to the old ninja loans of, again, the subprime era in the early 2000s, the no income, no job, no asset type loan. So the writer tried to compare this program to those ninja days, suggesting that presents more dangers. But I'm going to defend UWM here for a minute, because UWM argues that strict underwriting guidelines ensure high quality loans, and claiming that the critics, like this writer, are uninformed about current lending standards. That is absolutely true. See, the issue back in the subprime era in the early 2000s, right up to the crash of 08, had to do with the fact that you were able to get 0% financing, oftentimes split up between a first and a second, and there was virtually no underwriting at all. You could basically get 0% financing without having a job, without disclosing your income, without even disclosing the assets that you have to make the payments. That is completely gone now. I remember we could do what we used to call an 80-20, 80% first, 20% second, no down payment. You could state your income. You could state your assets, not have them verified, and you could have a credit score down to 580. That was, insane underwriting, because it was really no underwriting. That is what's so different from today. See, today, remember, in 2010, the Consumer Financial Protection Bureau came out with a whole set of new rules, basically under the concept of ability to repay. So any of you who've gotten a mortgage lately in the last few years, and that I've helped you with, you'll all know documentation of your loan file is extensive. We've got to document your income. We're going to document your assets. We're going to make sure that you have the ability to repay by verifying your income 6 ways to Sunday and calculating a debt ratio that's typically going to be at 43%. That's the target. You can sometimes go up to 50, but that's what happens today that was not happening during that era of 0% financing, when we weren't underwriting for the borrower's ability to repay. That's the critical difference. And besides that, to suggest that 100% financing is somehow a shady financial tool, I wonder if this writer has ever heard of VA loans, 100% financing, USDA loans, 100% financing. What about here in our state of California, the California Housing Finance Agency? That agency's been around for over 40 years, and that agency's core focus is to help first-time home buyers and to help them with down payment assistance, closing cost assistance. And in a lot of those programs, it's going to involve financing that's virtually going to be somewhere approaching 100% financing, no down payment. And those programs, again, VA, USDA, the Cal HAFA programs, those all have been working quite well. Why? Because they are extensively underwritten to make sure and to establish the borrower's ability to repay. So for that reason, I'm going to defend UWM here and suggest that this writer is a little off base to suggest their new program is a shady financial tool, because it simply is not. And so with that review of the article, I now want to get into the program details of what the UWM program is all about. So the first thing I want to show you is for the UWM program. It's a 30-year fixed rate program. It's available for 1-unit properties. That means single family homes, PUDs, that's planned unit developments. Think of a single family home. It's a single family detached home, but it's in a gated community. That is typically sort of the stereotypical planned unit development. So you got a single family home in a gated community with HOA dues. And then condos. What's disappointing about this program is no manufactured homes. That's unfortunate, because manufactured homes, if they're fixed to the land, they have become a pretty affordable option for buyers, particularly first-time home buyers, because they are lower prices. So it's a little disappointing this program is not available for those, but I think that has to do with the fact that the collateral, the manufactured home, is not considered as good as a traditional, what we call stick-built home. So that is one disappointing aspect of the program. The down payment assistance with this program is up to the lesser of 3% or $15,000 of the down payment. Notice it says $15,000 of the down payment, because in some of these transactions, the 3% or $15,000, may not cover the total amount of the 3% difference between the 97% loan and the purchase price. So in some cases, there may still have to be a little bit of a down payment provided, but not the full 3%. Now, as I mentioned earlier, the second lien, we also call it a silent second, is due upon refinance or the sale of the property or the payoff of the property, or when you make your final payment on the mortgage if you pay out the entire loan term. But of course, that's going to happen like 0.1% of the time, because almost nobody keeps a 30-year mortgage and pays it off to term the entire 30 years. That just doesn't happen anymore. There's no monthly payment on the second lien at all. There's no interest accrual on the second lien at all. That's a pretty good feature, frankly, because as you go into future years, if your home value does start to appreciate, and the old concept of time value of money, if you get to pay off that $15,000, 3, 4, 5, 10 years from now, again, time value of money says that's a great thing for you, because you're able to pay that off in later years when those dollars are not as valuable. So that really, in my mind, is a pretty good feature. And the down payment cannot be used for closing costs. So even with the down payment covered, in some cases, you may still have to have some cash for the transaction to cover those closing costs, both non-recurring and recurring, which, as you may recall, we covered that in detail last week. Minimum FICO scores for zero down payment purchase through the Home Possible program. You only need 620. And Home Possible, by the way, is a Fannie Mae program. Zero down purchase Home One is a 700 score. That's a higher score requirement. And by the way, Home One is through Freddie Mac. And that's part of this product. This product by UWM is basically sort of a twist on two existing programs through the two federal mortgage agencies, Home Possible with Fannie Mae, Home One with Freddie Mac. So additional features are, and this gets a little confusing, for a zero down purchase using Home Possible, you have to have income at or below 80% of the area median income. Again, this is a Fannie Mae product. In Riverside County, here where our office is in Palm Springs, that area median income is pretty modest. It's about $78,000. So that does make for a pretty small window of the ability to be eligible for the program based on the income limit, but then at the same time have enough income to actually qualify on debt ratio for the home you're interested in. And unfortunately, what it does mean with the Home Possible and the 80% of area median, it means the price level you can use this program for is pretty darn modest, probably in the very low 300, 3.25 range, maybe a little bit higher than that, which even in our valley here, there's not a whole lot of homes at that price level available for sale. Now, the other program through Freddie Mac, the Home One product, there is no area median income restriction. So that means you can make quite a bit more than 80% of the area median, go 100%, 120 or more, 150, and you are going to have this program available to you. So that is a good thing. But it does require that at least one of the occupying borrowers on the loan is a first-time home buyer. That's what that acronym FTHB, first-time home buyer. So Freddie Mac's program, as you can see, quite a bit different. And I think this one could end up being used more often. No area median income restriction. As long as at least one of the occupying borrowers is a first-time home buyer, this could be a great program, again, through Freddie Mac. With Home Possible, there is no first-time home buyer requirement at all. But again, you have that 80% area median income restriction. So I think that's going to probably diminish to some degree the use of the program using the Fannie Mae Home Possible. But again, on the other hand, remember on the credit score on the previous page, Freddie Mac does require a much higher credit score of 700, whereas Fannie does go all the way down to 620. So you've got these guidelines that are kind of at cross purposes with each other. The bottom line here, this could very well end up being a decent program for some of you out there if you're either a first-time home buyer or not, and you're looking for a way to finance a purchase with very little cash out of your pocket. So what you want to do is contact us. I can go over these programs with you in great detail, show you the numbers, figure out which of the program options, Home One, Home Possible, first-time home buyer or not, area median income requirement or not. I can navigate through all that for you and give you some detailed numbers on what's going to be the best zero down payment program for you when you're looking to purchase a home. We're a client of UWM. We have been for quite a long time. So and again, UWM, by the way, they're a national wholesale lender. They don't make loans to the general public. They get their loan volume through brokers like us. So if you have any interest in this program, my phone number is on the screen there. Give me a call. I'd be happy to go over it with you in detail and help you achieve home ownership, make it a reality for you. And with that, we'll go ahead and finish up the program with our closing question for next week. And this is a very, actually a very appropriate question, at least for my market area here in Palm Springs, because we are a second home market. We have a lot of condominium properties here in the Coachella Valley. We are considered a resort area. So here's the question. I was considering the purchase of a condo, but when I applied for the loan, I was told the rate and fees would be higher because it's considered a condotel. Why would that be? Again, very good question, very appropriate for my market area here in the Palm Springs area. So next week, we're going to dive into that in much more detail. So in the meantime, stay tuned. I'll have the answer for that question next week, and it will be on the house. So with that, I want to go ahead and conclude our show today. I want to thank you for watching and listening to the Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Stay tuned till next week. So long. Take care.